Boosting your credit score to qualify for better rates. This is super important when looking into getting a mortgage. The better your credit score, the better the mortgage interest rate for which you should be able to qualify. That can mean saving thousands of dollars over the life of your mortgage. If your credit score or somebody you may know needs some improving, keep watching this video for a few tips and tricks that I know that will help. My first tip is to make sure bills are being paid on time. This is one of the simplest ways. Nothing harms a credit score more than a late payment. Second, take time to check your credit report for errors. You can do this through Equifax, Experian, and TransUnion. Another source is annualcreditreport.com, which is a free way that the government has given you to check your credit data. These errors on a credit report are not uncommon and can really impact your score. Third, look into your credit utilization or CU rate. The CU rate is another big credit score consideration. Your CU rate is the amount of credit authorized versus the amount you're actually using. It is one reason why maxing out your credit card is not a wise move. A good rule of thumb is to never allow your CU rate to exceed 30% of your available credit at any time in the month. In simple terms, if you have $10,000 in available credit, never use more than $3,000. High CU rates are a red flag as they indicate somebody with potential financial problems. For best results, keep your CU rate as low as you can on each credit card account and also your overall CU rate. You can calculate this overall CU rate by adding up the credit limits of all your active cards and then adding up all the balances, divide the total balances by the total credit limit, and then multiply by 100. That will be your CU rate percentage. Now, another way to boost a credit score is by reducing your debt. If you carry any credit card debt, pay off as much as you possibly can. During this time, try not to open up new credit card accounts. Opening up new accounts can lower the age of your accounts, which could affect your credit history and your scores. Also, you may think it's a good idea to close your unused credit card accounts, but please don't. Once you close the account, your credit score can temporarily decrease, and that will also trigger your overall CU rate to increase. So since it's not a good idea to close unused credit card accounts, a good idea may be to refinance your credit card debt if you have a lot of it. And it could be put into a personal loan, refinancing it into a personal loan. When you do this, you should receive a lower interest rate with your balances merged into one single monthly payment. What is great about that is it will prompt your credit utilization rate to go down. Some people look at a credit card balance transfer, but it comes with a new account. This is often problematic because the new credit card's limit is often the amount of your balance transfer, thus giving you 100% CU utilization rate on that credit card. Now, although these are great ways to boost your credit score, you might be wondering how long will this actually take for improvement? It really depends on the severity of your credit problems. Serious credit issues can take years. However, other people, it can just take a few months when you're utilizing things like the CU utilization rate. So if you have any questions about your credit, you want any additional advice, feel free to give me a call or text me at 925-395-4212. Thanks so much.